When you hear quant trading, what pops into your head? You've probably seen the movies, right? Some mysterious black box humming away in a dark room, powered by math so complex it might as well be magic. But you know what? The reality is way more structured and honestly a lot more human than you'd think. So let's peel back the curtain and see what really makes these machines tick. This quote right here, this is it. This gets to the absolute core of quant trading. The whole philosophy isn't about some secret formula or a better crystal ball. No, it's about one thing: discipline. It's about taking a gut feeling, an intuition, what this quote calls a mood, and forging it into a set of cold, hard, repeatable rules. So, first things first, let's just bust the biggest myth right out of the gate. Quant trading isn't about some super intelligent machine brain replacing human judgment. Not at all. It's about changing when and how that judgment gets applied. It's really about taking the art of decision making and turning it into a science, basically industrializing it. Okay, this breaks it down perfectly. Think of it this way. On the left, the discretionary trader is like a jazz musician. They're improvising, riffing in the heat of the moment, reacting to the data, the news, the whole feel of the market. But the quant trader on the right, they're more like a classical composer. All the genius, all the critical thinking happens way in advance during the design phase. They write the sheet music, the rules, the models, all of it. Then execution is just the orchestra playing that music, perfectly, mechanically, and without a drop of emotion. So this is the key takeaway, right? The human is still the ghost in the machine. A person has to decide what data even matters, which signals are legit, and, this is the big one, when the world has changed so much that it's time to turn the whole thing off. It's not about getting rid of judgment, it's about formalizing it, writing it down, and testing it before a single dollar is ever at risk. All right, so let's keep going. If a quant strategy isn't magic, then what is it? The best way to think about it is like a factory. Seriously, it's an assembly line that takes in the raw material of information and spits out a finished product, a trade. And here's that assembly line. Step one is ingestion. We're just scooping up all the raw data, prices, news, you name it. This step, by the way, is super dangerous. Garbage in, garbage out. Then, step two, signal generation. This is where we transform all that messy data into something clean, like a standardized score. It's basically analysis turned into code. Next up, step three is sizing. This is crucial. Most systems use something called volatility targeting, which just means they take smaller positions when markets get crazy and bigger ones when things are calm, trying to keep the risk level steady. And finally, step four, the risk overlay. Think of this as the final quality check, a big red button, a circuit breaker that stops any trade that would violate the portfolio's biggest safety rules. Now, what's really fascinating is that even though there are thousands of different strategies out there, they pretty much all belong to one of four big families. And understanding which family a strategy belongs to is huge, because it doesn't just tell you what it believes about the market, it tells you its fatal flaw. It tells you how it's going to break. Here are the four families. First, you've got the divergent folks, like trend followers. Their whole worldview is that trends stick around. They're willing to suffer 1,000 paper cuts, lots of small losses, just waiting for that one massive home run trade. Then you have the opposite. The convergent strategies, like mean reversion. They bet that markets always overreact and prices will snap back. The problem? They die from a single gunshot wound. They win until that one time the price doesn't snap back, and boom, it's a knockout. Third, structural risk premia. These are the carry trades, earning a steady paycheck by taking on a risk nobody else wants, until the world changes and that premium just evaporates in a flash. And last, microstructure, or high-frequency trading. They find their edge in the nuts and bolts of the market itself. Their advantage is pure speed, and it is razor thin. It can literally vanish overnight because a competitor laid a faster cable. So how does a quant even know if any of this stuff works? Well, they backtest it. But here's the thing. The backtest is the most seductive and probably the most dangerous tool in this entire game. It can paint this beautiful, perfect picture of the future that's based on a past that is never, ever coming back. And that's the fundamental dilemma, isn't it? That's the billion-dollar question. You could have a backtest that looks absolutely flawless, but the real market isn't a history book. It's an adaptive, living thing. What worked yesterday might fail tomorrow precisely because it works so well that now everyone is doing it. And the reason backtests can be so misleading is because they are filled with traps. You've got overfitting, that's basically torturing the data until it confesses to a pattern that was just pure random noise. Then there's survivorship bias. It's like judging the health of all startups by only looking at Google and Apple and totally ignoring the thousands that went bust. You've got look-ahead bias, where the model accidentally peeks into the future using data it couldn't have possibly known at the time. And then there's the simplest trap of all, just forgetting about real-world costs, which can turn a genius idea into a money-losing disaster. Which leads to this critical shift in mindset. You shouldn't use a backtest to stand back and admire how great your strategy is. You should use it to torture your strategy, to find its breaking points, to figure out what makes it fail. It's not a validation, it is absolutely an interrogation. Because let's be clear, these machines do break. And when they break, that mechanical precision that's usually a strength becomes a terrifying liability. It can accelerate the damage at a speed that is just breathtaking. They don't feel panic, but they can fail in the most spectacular ways. When these systems do collapse, it almost always comes down to one of three things. The biggest one is a regime shift. This is when the fundamental rules of the market just change. Think a sudden jump from low to high inflation. The old rulebook just gets thrown out the window. Next is crowding. This is when everyone is doing the same trade and they all try to get out the door at the same time. It's a stampede with no exit. And finally, data integrity. A single corrupted piece of data gets into the system, and it poisons the entire assembly line from the start. And man, history is just littered with the wreckage. LTCM back in '98, that was a classic regime shift. Mathematical relationships that had been stable for decades just broke. The 2007 Quant quake was a terrifying lesson in crowding. Knight Capital in 2012 was a pure machine failure, a software bug that went haywire. And option sellers in 2018, a brutal reminder of what happens when a risk-premium strategy blows up. A system built to make a little bit of money every single day can be completely annihilated in one violent move. So we kind of end up right back where we started. Automation, for all its power, doesn't get rid of risk or the need for real human insight. What it does is it takes all of that judgment, all of those biases and beliefs about how the world works, and it concentrates it. It focuses it all into the code that the machine will then follow blindly no matter what. The risk doesn't vanish, it just gets hyper-focused. And that, I think, leaves us with a final, most important thought. We spend so much time asking if these complex quant systems are smart, but maybe that's just the wrong question. The machine is only ever as good as the rules it's given. So the real question isn't about the intelligence of the machine, but about the wisdom, the foresight, and maybe most importantly, the humility of the humans who built it.